Same ETF, same $500,000, same 15 years. Only the name changes. Maya's illustrative rate is 39%. The passive company pays 30%. Obvious winner? The company. It is not. After costs, sale, and getting the profit back to Maya, it finishes $115,816 behind personal ownership. The trust leads by only 5,932, roughly half of 1% of the ending cash. Now we follow every dollar. This is general educational information, not financial, tax, or legal advice. The people, tax rates, returns, and costs are controlled assumptions, not a recommendation or a quote. Actual outcomes depend on the investor, the documents, the ETF, the law and professional implementation. Before the first dollar moves, 4 rules are locked. Maya starts with new cash on the 1st of July 2027. Every lane receives the same generic ETF, the same 15-year holding period, and the same final sale. An existing portfolio is deliberately excluded because changing its owner can create tax and legal consequences of its own. Every lane receives the same illustrative 7% nominal return, 2% cash distributions, and 5% capital growth. The CPI illustration is 2.5%. The scoreboard is not the balance inside the structure. It is cash Maya could use personally, after tax, setup, administration, sale, and, where needed, company extraction. Real ETF statements can contain franking credits, foreign income, fund realized gains, and cost base adjustments. Those are excluded, so the owner, not the ETF, is the variable being tested. The individual lane is the clean comparator. Maya owns the units, receives the distributions, records the gains and losses, and has no separate entity invoice in this model. Because this fresh investment begins after July 2027, the new Australian CGT rules matter. For eligible Australian individuals and trusts holding an asset for at least 12 months, the cost base can be indexed for inflation. The remaining gain can then face a 30% minimum tax calculation. The legislation is more detailed than one flat rate, so the model uses a transparent shortcut, an indexed gain and the higher of the illustrative personal rate, or 30%. It is an approximation, not a tax return. After 15 years, Maya's individual portfolio reaches about $1,236,000 before the final sale. After the modeled sale tax, she has about $1,102,000. Between those two numbers sits about $134,000 of terminal capital gain tax. The model has also paid roughly $92,000 of tax on distributions along the way. Those annual taxes are already reflected in the portfolio balance because only the remaining cash is reinvested. The individual lane has no distribution flexibility, but it also has no structure cost trying to earn its keep. In the second lane, a discretionary trust owns the ETF subject to its deed and the tax rules. The trustee can make eligible beneficiaries entitled to trust income and particular tax components. That flexibility only creates value when an eligible beneficiary genuinely has a different tax position. It requires valid records and an economic entitlement. The model does not suggest trust cash can be moved informally. Maya's base scenario uses a beneficiary rate of 32%. It also pays $2,500 of illustrative setup cost and $2,000 of first-year administration, rising with inflation. These are illustrative all-in assumptions, not Australian averages. Actual prices depend on the trustee, documents, state, records, and services. The trust reaches about $1,217,000 before sale and $1,102,000 $108,000 after sale. Its lower beneficiary rate reduces distribution tax to about $63,000, compared with roughly $92,000 in the individual lane. But setup and administration consume about $38,000 over the same period. The final capital gain tax is approximately $109,000. That is the trade in plain view. The trust creates tax flexibility, then asks that flexibility to repay 15 years of extra cost. That is only about $5,900 ahead of the individual over 15 years. One changed fee, beneficiary rate, or ETF tax component could reverse it. And if the beneficiary rate is also 39%, the flexibility adds no rate advantage. In the tested range, the trust never catches the individual below $2 million of starting cash because it adds cost without reducing the modeled tax. Trust losses create another boundary. An overall trust tax loss generally stays in the trust, rather than being handed to a beneficiary to reduce unrelated personal income. The company lane explains why the opening tax rate comparison failed. This controlled company earns predominantly passive ETF income, so the model uses the 30% company rate, not the lower base rate entity rate. It can keep after-tax profit invested inside the company, which may defer the shareholder's personal tax. That lower annual rate helps the company portfolio reach about $1,235,000 before the terminal sale, almost level with the individual, despite its additional costs. This is why stopping the comparison at the company balance can be so persuasive. But company money is not Maya's personal wallet. Payments and loans can trigger Division 7A, so the model uses a conventional, documented path. Maya lends the original cash to the company. At the end, the company sells the ETF, repays the shareholder loan principal, then distributes the remaining profit as a fully franked dividend using the available franking credits. The company does not receive the new individual and trust indexation treatment in this model. Its nominal ETF gain is taxed inside the company. After that sale tax, the company holds about $1,058,000. That is the first gate, and it still looks respectable. The first $500,000 repays Maya's original shareholder loan. The remaining roughly $558,000 is paid as a cash dividend with available franking credits. But at Maya's illustrative 39% extraction rate, the dividend creates another $72,000 of shareholder tax after franking credits. Personally usable cash falls to about $986,000. The company's 30% was real. It simply was not the final family tax rate. Fixed costs become more important when the portfolio is smaller. Starting with $250,000, the individual finishes at about $551,000, the trust at $533,000, and the company at $480,000. The individual leads this scenario. At $500,000, the trust leads by less than $6,000. At $1 million, the modeled trust lead becomes more visible. Starting with $1 million, the final usable amounts are about $2.204 million for the individual, $2.257 million for the trust, and $1.998 million for the company. Under the base assumptions, the trust first catches the individual at roughly $438,000 of starting cash. That is not an Australian rule, a recommended threshold, or a quote for when to establish a trust. It is one model's crossover. Change the costs or beneficiary and the marker moves. The beneficiary rate is the trust's most powerful dial. At an illustrative 16%, the trust crossover falls to around $235,000. At 39%, it disappears below 2 million. There is also an announced 30% minimum tax for discretionary trusts from July 2028. It is not included in the legislated base case because implementation details are still being finalized. Its direction is clear. It could reduce the benefit of allocating income to a beneficiary below 30%. The script does not pretend the final design is settled. The company's key dial is the shareholder rate when profit finally leaves. At a future 16% illustrative rate, the $500,000 company scenario produces about $1,169,000 after full extraction. At 47%, it falls to about $922,000. So a company can change the timing of personal tax. It does not create a permanent universal 30% ceiling. So, the next dollar call. The individual lane is the clean starting comparator. A trust does more work when genuine beneficiary flexibility is available and valuable enough to exceed its cost. A company can do more work when profit remains invested and the eventual extraction path is favorable. Neither label wins without those facts. The honest price is complexity the model cannot score. Deed terms, records, control, estate planning, asset protection, and the consequences of changing an existing owner. Those belong with appropriately qualified tax and legal professionals before anyone acts. If you want Australian investing structures tested through the full numbers, not just one attractive tax rate, subscribe to the Next Dollar Australia. The free comparison below shows every assumption and the questions to take to an accountant or lawyer. And for the tax change driving the new capital gain treatment, the July 2027 CGT video is on screen now.